All right, let's dive in. Today, we're going to decode two of the most important numbers you hear about in the Indian economy, the Sensex and the Nifty. By the end of this, you'll have a super clear guide, perfect for acing an exam or just, finally getting what everyone's talking about.
So, let's get right down to it. You hear it on the news all the time, right? The Sensex surged 500 points, or the Nifty hit an all-time high. But what does that actually mean for the market and for the country's economy? Well, that's the big question we're unpacking today. But hold on. Before we can really get into the nitty-gritty of Sensex or Nifty, we need to zoom out a bit. We've got to understand the big idea that they're both built on, the whole concept of a market index.
Okay, the best way to think about an index is like a highlight reel for the stock market. I mean, it's impossible to track thousands of companies all at once, right? So what an index does is it picks a representative group, a sample, and boils down their performance into one single easy-to-read number. It's the ultimate snapshot. And this quote, it just nails it. An index acts as a market barometer. Think about it. Just like a real barometer tells you about atmospheric pressure if a storm's coming, a stock index measures the collective mood of the market. It's a direct gauge of investor confidence and the overall financial weather. Okay, so with that foundation in place, let's bring it home to India and look at the two big players that dominate the conversation. Of course, the Sensex and the Nifty. Here's a really simple way to frame these two in your head. Think of the Sensex, which comes from the Bombay Stock Exchange, as the classic, the original indicator. And then you've got the Nifty from the National Stock Exchange, which is its more modern, slightly broader cousin. One's the classic, the other's the modern benchmark. Simple as that. All right, for anyone studying for an exam, this slide is pure gold. You might want to pause here. It lays out all the key differences you need to know side by side. You can see the Sensex is on the BSE with 30 companies, while the Nifty is on the NSE with 50, so it's a wider snapshot. But, and this is a classic exam question, look at the base values. Sensex started with a base of 100, while Nifty began at 1,000. These are the kinds of distinctions you'll want to lock in. Okay, so how do we actually get from the performance of 30 or 50 different companies to a single number like 60,000? Let's get into the mechanics. This isn't just random. There's a very specific, globally accepted way of calculating it. The method behind both indices is called Free-Float Market Capitalization. Now, that sounds like a total mouthful, I know, but trust me, the logic behind it is actually really intuitive. Let's break it down, step by step. First up, we start with the basic idea of market capitalization, or market cap. It's as simple as it sounds. You just take the total number of a company's shares and multiply that by the current share price. That gives you the total theoretical value of the company. Easy enough. But here's the crucial adjustment, the key difference. The index calculation doesn't use that full market cap. Instead, it uses the free float value. This only counts the shares that are actually available for you and me to trade on the open market. And that gives a much more realistic picture of a company's value based on real-world supply and demand. So what exactly gets left out? Well, the calculation filters out any shares that are locked up and not really trading. We're talking about shares held by the founders or promoters, big chunks held by the government, or shares owned by company insiders. By taking these out, we get to the true float of shares that actually influence the daily market price. And all those pieces come together in this one elegant formula. The final index value is calculated by taking the current free float market cap of all the companies, dividing it by the base market cap from way back in the starting year, and then multiplying all of that by the base index value. Remember what those were? 100 for Sensex and 1,000 for Nifty. And that's it. That's how we get the number you see on the news every single day. Okay, so that covers the what and the how. But now for the most important part, the so what. Why should any of this actually matter? To investors, to economists, or even to you? It boils down to three huge roles. First, they are the ultimate benchmark. When you hear a fund manager say they beat the market, they mean their returns were better than the Sensex or Nifty. Second, they are that economic barometer we talked about, a vital sign for the nation's financial confidence. And third, they are the basis for investment products. Things like index funds or ETFs are built directly on top of them, letting you invest in all 50 Nifty companies in a single shot. So, as we wrap this up, I want to leave you with one last really important question to think about. Since these powerful indices are designed to focus only on the biggest and most established companies,
What part of the story are we missing? What trends, what innovations, and what economic shifts are happening among thousands of smaller companies that this one single number just doesn't capture?